All right, we're recording now. Share my screen. All right, chapter 2, processing accounting information. So maybe I should make this. There we go. So identify the 5 major steps in the accounting cycle. We have analyzing. So you analyze transactions from their source documents. Suppose you buy some supplies, and the supplies come in the mail, or they're delivered to your factory. And with the supplies is an invoice. You can record the transaction from that invoice. It has a date, it has the amount, it has what was bought, and those sorts of things. So analyzing is the first step in the accounting cycle. For each transaction that you analyze, you record it. And when we say record it, we mean you make a journal entry. And then after you've journalized all the transactions for a given period, usually companies prepare an unadjusted trial balance, monthly, quarterly, definitely annually. So you prepare an unadjusted trial balance, which essentially is just a listing of all the accounts that you have, all the asset accounts, all the liability accounts, all the owner's equity accounts. You list each account, and beside each account, you put its balance. On the unadjusted trial balance, you can verify that the accounting equation holds. If you add up the balances in all the asset accounts, you get a number. That number should be the same as the number that when you add up the balances in all the liability and the owner's equity accounts and add them together. But the trial balance is unadjusted. Then you make some adjustments at the end of the period. And for each adjustment, you journalize the adjustment. So you make a journal entry. We're going to talk about what's a journal entry in this chapter. And then after you've journalized all the adjustments, you've made all the adjustments, then you can prepare an adjusted trial balance. So when you do an adjusting journal entry, some of those asset, liabilities, and or stockholders' equity accounts will be affected by those journal entries, and their balance will change. Some of the accounts won't change because they won't be affected by the adjustments, but some of the accounts will change. So you're going to need to prepare an adjusted trial balance. And then after you've prepared the adjusted trial balance, you can prepare the financial statements, which is basically you're reporting the results to the shareholders and to the creditors and to the regulators. You're releasing your information publicly, you're reporting. Excuse me. And then after preparing the financial statements, you close the books. So you make closing entries, you make journal entries that close the books, and then you prepare post-closing trial balance. The accounts that are closed are all the income statement accounts, the revenue and the expense accounts. The balances in those accounts is wiped out and closed out to make it zero at the end of every period, so that it starts over at the beginning of the next period. And so the only accounts that have a balance in them that's not zero after closing would be the balance sheet accounts. And you can verify that the accounting equation holds after closing. That's the post-closing trial balance. So we're going to go through this today. We're going to pay a particular attention to step number 2, recording the transaction. How do we record a transaction? How do we make a journal entry? That's what we're going to focus on today. Although we will talk about the other steps as well. So the accounting equation does provide a convenient way to analyze and summarize the various economic transactions that happen within a given period for a company. And you guys remember this equation. So every economic transaction the company engages in must be recorded in the company's accounting records, as long as one of the elements of the accounting equation is affected. If nothing on the account, if none of the three elements of the accounting equation are affected, then you don't record the transaction, of course. Hannah says, can you go back a slide? Yes. Back to here, Hannah. Yeah, you're welcome. All right. So after recording an economic transaction, and we're going to talk about how do you record an economic transaction, but after you record it, the accounting equation needs to still hold. It has to stay in balance. So that means that when you record an accounting transaction, at least two elements of the accounting equation will always be affected. And this leads to the phrase double entry accounting. If you've heard of double entry accounting, that's what accountants do. You make every journal entry involves at least two accounts. There's two entries to be made. One journal entry involves at least two accounts, at minimum two accounts. That makes sure that the accounting equation will stay in balance. And we'll explain this as we go further. Thank you, Sophie. So here's the accounting equation, and we can further expand it, right? Stockholders' equity is comprised of two things: common stock, which is our contributed capital. This is the money that's given to us by our shareholders. And retained earnings, this is the money that we've generated as a company from selling our products and services. The earned capital. Contributed capital, earned capital. And you know that retained earnings further can be broken down. Revenues, expenses, and dividends. So this is the change in retained earnings. Total revenues minus total expenses, which is net income, minus dividends, gives the change in retained earnings. All right, let's make sure we're on the same page. What's the first step in the accounting cycle? Do we report first? Do we analyze first? Do we record first? Or do we adjust first? A, B, C, or D? Analyze, thank you. B. Good. All right, so Ben, I'm going to keep going. Here's a previous slide, but you can download the slides from Blackboard, and also you can watch this video again on YouTube and slow it down. I have a lot to get through between now and 1:05. No offense intended. Make sure I get through these things. Otherwise, you won't have a full lecture to watch on YouTube. All right, so what we're going to do throughout the rest of today is based on this running example. So Mike Lester established Mike's Bikes on December 1st, 2019. Mike's Bikes, think of Mike's Bikes as a corporation. They're a separate entity from Mike Lester. Mike's Bikes purchases bikes from various suppliers and sells them to customers. So Mike's Bikes essentially is a retail company. They buy a bike from someone else, a finished bike, for some price, say $100. Then they mark the price up to $150 and sell it to someone else. That's what Mike's Bikes does to make money. So the following slides will illustrate several accounting transactions. And the key thing here is be sure to note that the accounting equation remains in balance following the recording of each transaction. So on December 1st, 2019, Mike invested $30,000 cash into Mike's Bikes. In exchange, Mike's Bikes, the company, gave Mike some of the company's common stock. So from Mike's Bikes standpoint, it's always from the company's standpoint. From Mike's Bikes standpoint, they just received $30,000 from this person named Mike. And in exchange, they gave Mike some shares of stock. So that's the accounting, or that's the economic event that happened. And we have to account for that. So the two accounts involved, remember, every event involves at least two accounts. The two accounts involved are cash and common stock. Cash is an asset and common stock is owner's equity. Mike's Bikes received $30,000 of cash, so their cash went up by $30,000. And ownership in Mike's Bikes, that's what common stock is, the dollar value of ownership in the company, that went up by $30,000 as well. I'm gonna get my pen out. The effect of this transaction on the accounting equation is assets went up by $30,000, liabilities were not affected, and owner's equity went up by $30,000. So the equation stayed in balance. These three elements were 0, 0, 0 before this transaction. After this transaction, the three elements now are 30,000 equals 0 plus 30,000. The equation is still in balance. All right, next thing that happens. Mike's Bikes on December 1st prepaid a year's building rent at $500 per month, which means they paid $6,000. So they paid for the next year's worth of rent, $500 a month times 12 months, $6,000 of rent they prepaid. That's how rent works. You pay in advance and then you get the benefit of living in the space or occupying the space that you're renting. Just like your apartment, you pay in advance and then you get to live there for a month. Then the next month, at the beginning of the month, you pay again. Then you get to live there for the month. You don't pay, you don't live there. The two accounts involved, one of the accounts is easy, cash. And cash goes down, right? It goes down by $6,000 on December 1st. But the other account is called prepaid rent. Both accounts happen to be assets. Prepaid rent is an asset. It reflects that as of December 1st, Mike's Bikes has $6,000 worth of future economic benefit that they can take advantage of in the form of being able to occupy this space. I'm sure this building they're renting is the building they're going to use to house their bikes. They're going to sell the bikes out of that building. An asset, we haven't really defined an asset yet. The formal definition of an asset is just an economic resource that provides a company a current or future economic benefit. And when we say the word economic, we mean dollar benefit. So on December 1st, Mike's Bikes gives up $6,000 of cash. That's one asset they give up. In exchange, they get another asset. They get the benefit of being able to occupy this building for the next year. That's worth $6,000. So the accounting equation after this transaction, after recording the transaction, goes down by 6,000 and up by 6,000. So the accounting equation stays in balance. Assets are still 30,000. They go from 30 down to 24, but then they go back up 6. So then they go back up to 30. Liabilities are not affected. Owner's equity is not affected. What we haven't shown you yet is exactly how to make the journal entry for the transaction. And we're going to do that next. Is everyone with me so far? Thank you. The hardest thing with these economic transactions often is figuring out which accounts are involved. And then once you figure that out, figure out, does the account go up or down? Some of them are pretty self-explanatory. Other ones are a little trickier. But remember, at minimum, or at least 2 accounts are involved in each economic transaction. 2 at least, sometimes more than 2. The next transaction that happens at Mike's Bikes is on December 1st, Mike's Bikes purchases 3,000 of merchandise inventory on account. In other words, they buy some bikes for $3,000. But the key phrase here is they don't purchase $3,000 worth of bikes with cash, they do it on account. So the two accounts involved, cash isn't involved. The two accounts involved are merchandise inventory, which represents the dollar value of the bikes that they just got. So they get $3,000 worth of bikes, merchandise inventory. And in exchange for that, they give whoever gave them those bikes, the supplier, they give them a promise that they're going to repay them in the future within the specified payment period. Usually the supplier will give you 30 days to pay off your account. And so that promise is a liability from Mike's Bike standpoint called accounts payable. The two accounts involved, merchandise inventory, which is an asset, and accounts payable, which is a liability. Merchandise inventory goes up by 3,000. So assets go up by 3,000. Liabilities, accounts payable is a liability. It goes up by 3,000. We have $3,000 more liability now than we had before because now we're liable to pay this 3,000 back to the supplier. And stockholders' equity is not affected. So the accounting equation stays in balance. Assets go from 30,000 up to 33,000. And then liabilities go from 0 up to 3,000. Stockholders' equity remains at 30,000. So the right-hand side is also 33,000, same as the left-hand side. Next transaction that happens, December 1st, Mike's Bikes, we have a question. David asks, so whenever inventory or supplies is purchased, liabilities go up. It depends, David. If the inventory or the supplies are purchased with cash, then liabilities don't go up. You simply trade one asset for another. You trade your cash, and in exchange, you get your inventory or your supplies. However, if you don't pay cash and you still get inventory or supplies, then yeah, the liabilities go up. Suppliers don't give you inventory or supplies for free. So you'll get the inventory or the supplies, that'll go up, and your accounts payable will go up, your liability will go up. You're welcome, David. You're right, Simranjeet. December 1st, Mike's Bikes obtained a 2-year bank loan in the amount of $20,000. Excuse me. Annual interest charges on the note amount to 6% and are due each November 30th. So what accounts are involved? Cash. Mike's Bikes gets $20,000 from the bank. And the other account is a liability. It's called a note payable. So note payable goes up by 20,000 right here. So liabilities go up by 20,000, and then cash goes up by 20,000. So assets go up by 20,000. So the left-hand side of the accounting equation goes from 33 up to 53. The right-hand side of the accounting equation, because liabilities go up, goes from 33 up to 53. And owner's equity is not affected by this transaction. December 2nd, Mike's Bikes purchased equipment that they used for bike maintenance and assembly. Mike used $15,000 cash from the bank loan to purchase the equipment. What accounts are involved? 2 accounts, cash and equipment. Cash goes down by 15,000 and their equipment goes up by 15,000. Cash is an asset, so cash goes down by 15,000. The balance in cash goes down by 15,000. And the balance in equipment, there wasn't an account equipment yet, but now there is one. It goes from 0 up to 15,000. And since both are assets don't change, right? They go up by 15 and they go down by 15, so they don't really change. You can reflect that by just putting nothing here, or you can go up and then down like that. Liabilities aren't affected. Owner's equity isn't affected. Cash and equipment are both assets. So the accounting equation stays in balance. Still 53,000 on the left, 53,000 on the right. We have a question. Let's see. We will definitely answer that question, Alexis. Another question, or how is the accounting equation impacted when equipment depreciates in value? We'll answer that question as well. Good questions. Both of those questions will be answered. All right, we hire a part-time employee. So this economic event is simply we hire the employee. And we intend to pay the employee $1,000 per month. Do we make an entry? Do we need to account for this economic event? You're right, Alexis. No account is affected. No assets, no liabilities, and no owner's equity accounts are affected. So we don't. We don't. There's no account. There's no entry that needs to be made. Sold bikes. During December, Mike's Bikes sold $12,000 of bikes. In exchange, they got cash. So we gave up $12,000 of our merchandise inventory. And in exchange, we increased our cash by $12,000. So cash goes up by 12,000. Now it's not showing the decrease in the merchandise inventory here. But it is showing what else happened. We earned $12,000 of revenue. So we have to recognize the $12,000 of revenue. Revenue goes up by 12,000. What it's not showing is the other. So whenever we sell inventory, there's actually 2 journal entries needed. One to reflect the fact that we've earned revenue. That's what this one is. But the other entry that's also needed, which they're skipping over on this slide, even though it is, you do have to do it, but they don't do it on this slide. And the reason they don't is they feel like it gets too complicated at first, and we'll get to that later. And we'll get to it. But there is another entry needed. Your merchandise inventory has to go down by 12,000 because you have $12,000 worth of bikes less than you did before because you gave them away to your customer. And also your cost of goods sold expense has to go up. So one entry shows that cash goes up and revenue goes up, and the other entry shows that merchandise inventory goes down and expenses go up. And we'll talk about that second entry later. But for right now, when you sell something, just think about there's just one entry. You get cash and your revenue goes up. What if you sold the bikes on account? You didn't get cash from your customer yet, but you got a promise that they're going to pay for them later. Well, your revenue would go up, but the asset that would go up instead of cash would be accounts receivable. Accounts receivable reflects the dollar value that you expect to collect from your customer in the future, and that represents a future benefit to you. So that's an asset. So if you don't get cash, you're going to your accounts receivable is going to go up when you sell an item. If you do get cash, obviously your cash is going to go up when you sell an item. David said, would there be a decrease in 3,000 in merchandise inventory? There would be, David. Right. There would be a decrease So they only have $3,000 worth of bikes in their inventory and they just sold them. I'm assuming they sold all of them. So the inventory, merchandise inventory would go down by 3,000. This is what they charged the customer for those bikes. But that's not what they originally paid for them. They originally paid 3,000. So the other entry, David, was merchandise inventory goes down by 3,000 and expenses go up by 3,000. Cost of goods sold expense in particular. But we'll talk about that later. Simranjeet, yeah, you're right. Nothing is affected when you hire an employee. Just a simple fact of hiring the employee doesn't affect the accounting equation. All right, so for this one, assets went up, liabilities weren't affected. And owner's equity goes up because revenue goes up. So now is a good time. If we look at our owner's equity, it's comprised of common stock and retained earnings. Retained earnings is comprised of revenue, expense, and dividends. Revenue minus expense is the net income, right? So what's the effect on owner's equity when revenue increases? When revenue increases, then retained earnings increases, which makes owner's equity increase. What about expenses? What's the effect on owner's equity when expenses increase? When expenses increase, everything else held constant, what happens to retained earnings? Goes down, right? Because revenue minus expense, which is net income, goes down whenever expenses go up, everything else held constant. And if retained earnings goes down, then owner's equity goes down. So the effect of revenue on owner's equity is a positive effect. The effect of expenses on owner's equity is a negative effect. There's a negative relationship. What about dividends? When dividends go up, what happens to owner's equity? Dividends go up, that means retained earnings goes down because dividends are paid out of retained earnings, which makes owner's equity go down. So there's also a negative relationship between dividends and owner's equity. So that's important to know. All right, let's keep going. Now, remember that employee that we hired? It's the end of the month. At the end of December, Mike's Bikes paid its part-time employee $1,000. Two accounts involved here. Cash and wages expense. Cash is an asset. Cash goes down. Assets go down. And expenses are right here. Expenses go up by 1,000, but that means, but when expenses go up, owner's equity goes down by 1,000 because of what I just talked about, the negative relationship, and that's why they have a negative sign there. So owner's equity goes down as well. Liabilities are not affected. Again, the accounting equation stays in balance. This accounting equation serves as, and this double entry system, double entry accounting, it's the world's best self-correcting error code. In other words, you know if you made an error in your journal entry or in your accounting. We're going to get to journal entries in a second. I haven't really talked about what is a journal entry. We're going to get there. But you know you've made an error in accounting if the accounting equation no longer holds. The self-correcting error code. One of the world's first examples of a self-correcting error code. This double entry system of accounting was, I haven't told you guys, but it was developed in 1494 by an Italian mathematician named Louis Pacioli. That's when accounting was invented, the double entry system of accounting. And we've been using it ever since. All right, someone had a question. What is owner's equity? Yes, Sarah, that was covered a while ago. Owner's equity in general is just a total dollar value that we've received from our shareholders in exchange for shares, plus the amount that our company has earned by selling our products and services. It's the sum of common stock dollar value and retained earnings. That's what owner's equity is. And if you want a more indirect or informal definition, owner's equity represents the shareholders' claims on your assets. So if we have the accounting equation, whoops. Liabilities are the creditors' claims on your assets. Creditors being the people that have lended us money or lended us products or services and we haven't paid them yet. Liabilities represent the creditors' claims on our assets. Owner's equity represents the owner's claims on our assets, the shareholders' claims on our assets. So if we were to file Chapter 11 bankruptcy in a legal setting, we file bankruptcy as a company. What's the first thing you do when you go bankrupt? You liquidate your assets. You sell all your assets and you get a bunch of cash. And what do you do with all that cash? First, you have to satisfy the creditors' claims on that cash. You pay the creditors back. And then if there's any cash left over, you can give it to your shareholders. So legally, liabilities are the creditors' claims on your assets. Owner's equity represents the dollar value of the shareholders' claims on the assets. And a lot of times when a company goes bankrupt, the shareholders don't have much claim on the assets because once they liquidate the assets, there's barely enough money, maybe even not enough money to satisfy all the liabilities. You're welcome, Sarah. All right. Let's see if we're on the same page. When a company purchases supplies on account, what does that involve? Right, C. When you purchase supplies on account, you think to yourself, okay, what are the two accounts involved? Supplies and accounts payable. Supplies goes up or down. Does it increase or decrease? Supplies increases. Is supplies an asset, liability, or owner's equity? It's an asset. So assets increase. Accounts payable goes up or down? It goes up. Accounts payable is what we owe our suppliers who've given us stuff. So whenever we purchase supplies on account, accounts payable goes up. Accounts payable is a liability, so liabilities go up. Assets go up, liabilities go up. C, you guys answered right. All right. Now we get to some of the most important stuff for the whole course. Explain the nature, format, and purpose of an account. We're going to go back and talk about what an account is, like cash or accounts payable. So an account, it's just an individual record of the increases and decreases in a specific asset, liability, or stockholder's equity item. And the account we often refer to as a T account. Because, like cash, for example, we can form a T. We have entries on the left-hand side and entries on the right-hand side. Notice in the slides previous to this, cash was involved a total in 7 of the economic transactions. Cash was involved in 7 of them. If you go back a few slides. Cash starts the year with a balance of 0. Remember? And then we put 30,000 in it because Mike gave Mike's bikes $30,000. And then you can go through all the transactions. The ending balance in cash after all those transactions was $40,000. And this would be a good place, if you're watching the YouTube video, to pause the video and go back through the slides. Make sure you can trace that change in cash, how cash went from 0 up to 40,000 based on each transaction. Some of those transactions involved increasing the cash account, and some of those transactions involved decreasing the cash account. All right, now we talk about debits and credits. And this is where students get the most confused, usually. Exactly, Alexis. How do you know which side the balance goes on? We're going to answer that right now. All right. In accounting, when we use the word debit and when we use the word credit, you need to divorce yourself from any previous notion you have of what those two words mean. I can tell you what those two words mean to you currently before taking this class. They're based on your checking account, right? Your bank account. With your bank account, the word debit means a decrease, and the word credit means an increase. Just divorce yourself from that right now. The word debit and the word credit have different definitions in accounting. They're the same words, but they have different definitions. They're defined in a different way. In accounting, debit simply means the left-hand side of the T account. An entry on the left-hand side of the T account is a debit. An entry on the right-hand side of the T account is a credit. The definition of debit in accounting has nothing to do with increases or decreases. It has to do with which side of the T account we're putting the entry on. The definition of debit in accounting is we made an entry on the left-hand side of the T account. The definition of the word credit in an accounting sense is we make an entry on the right-hand side of the T account. The credit side. The credit side is a right-hand side of the T account. The debit side is the left-hand side of the T account. Now, depending on what T account that is, whether that T account, what category of account that is, for some T accounts, entries on the left-hand side, aka debits, they increase the account's balance. And for other accounts, debits decrease the balance. Same thing with credits. For some accounts, credits increase the balance, and for other accounts, credits decrease the balance. This is why it's confusing to students who are just used to thinking in terms of their own checking account, where debits are always decreases and credits are always increases. Are you guys with me? In accounting, debit means left-hand side of T account. Credit means right-hand side of T account. You could just replace this word debit with left-hand side. Replace the word credit with right-hand side. It takes longer to say left-hand side or right-hand side. So a long time ago, Louis Pacioli, the one who invented accounting, he gave the word debit to the left-hand side. And he gave the word credit to right-hand side. It's unfortunate that he chose those words. Actually, it's not unfortunate. It's unfortunate that banks decided to choose those same words where debit means always decrease and credit means increase. They should have chosen different words, because before the banks, we knew the words had different definitions. It's an unfortunate choice of words. But this one thing right here trips up students throughout, often even into intermediate accounting. They still get confused because they're confusing the definition of debit and credit. They still can't divorce themselves from the notion of what they think a debit and a credit are relative to their own bank account. All right, let's keep going here. All right, we're going to go back and we're going to make a journal entry for each of those transactions that happened at Mike's Bikes on the previous slides. So what is a journal entry? A journal entry Here is an example of a journal entry. You have the date, not just a year, but the actual day. December 2nd, 2019. You have at least one account is debited and at least one account is credited. You can't have 2 debits and no credits, or 2 credits and no debits. At minimum, at least one account is always debited and at least one account is always credited. You could have 1 debit and 2 credits, or 2 debits and 1 credit. So you have the account that's debited on top, and if there are any other accounts debited, you put those on top and you indent them to the left. Then the accounts that you're going to credit are put on the bottom and you indent them to the right. Then you put the dollar value of the debits and the credits, and then you write a little description of what this journal entry is doing. And this is the journal entry for that first transaction where Mike's Bikes received $30,000 of cash from Mike. So it says issued stock in exchange for cash. So Mike's Bikes issued stock, gave stock to Mike, and in exchange received cash. So this journal, is just a description. And here's the journal entry that reflects this right here. This part of the journal entry is what you're going to be doing the rest of this course. You're going to be doing lots of these. Yes, of course, you need the date and you need a description, but this is the accounting for it. Another thing you can do is so along with this journal entry, we can have, all right, we have our 2 T accounts. We have a T account for cash and we have a T account for common stock. After the first transaction, we debited cash for $30,000 and we credited common stock for $30,000. So the balance in cash after this is a debit balance of $30,000 and the balance in common stock is a credit balance of $30,000. All right, I'm going to give you guys, I'm going to stop. How do I stop this presentation for just for a second? And I'm going to give you guys an acronym that you can use to help you memorize which accounts have normal debit balances and which accounts have normal credit balances. I'll upload this to Blackboard because it's that important. So this acronym. Well, before I state the acronym, I should define what does an account's normal balance mean. So the normal balance of a T account is either going to be debit or credit, depending on which of these, debit or credit, you need to do to increase the account's balance. So the normal balance of an account is what you have to do to increase the account's balance. If you have to credit an account to increase its balance, then those accounts all have normal credit balances, which means at the end of the period, if you look at the account's balance, it should be a net credit. If you have to debit an account to increase its balance, that means those accounts have normal debit balances. at the end of the period, they should have a debit balance. And so to remember which accounts have normal debit balances and which accounts have normal credit balances, which means another way to say that is for which accounts, when you debit them, does that increase their balance? And for which accounts, when you credit them, does that increase their balance? You can use this acronym, dealer. Think of the word dealer, but we break it up into two parts. We have D stands for dividends. E stands for expenses. A stands for assets. So if an account is a dividend account, an expense account, or an asset account, that means that account, to increase their balance, you have to debit it, which means these accounts have normal debit balances. Debit is often abbreviated DR, and credit is abbreviated CR. So for these accounts, you increase them with a debit, you decrease them with a credit. These accounts have normal debit balances. Why normal debit balance? Because it takes a debit to increase those accounts. These accounts over here have normal credit balances. Liabilities, owner's equity, when I say owner's equity, you might say, well, expenses are part of owner's equity. That's true. Expenses do affect owner's equity. When I say owner's equity over here, the O just means common stock or retained earnings by themselves. And then R stands for revenue. Revenues. So if an account is a liability account, if it's a common stock or retained earnings, that's owner's equity account. Or if it's a revenue account, then those accounts have normal credit balances, which means you increase them with a credit, you decrease them with a debit. So these accounts are increased with a credit and decreased with a debit. Which means these accounts, since a credit increases them, they have a normal credit balance. So, given any economic event, you figure out which accounts are involved. For each of those accounts that you've determined are involved, you need to put into each of those accounts into one of these 6 categories. Any account in accounting within a company is put into one of these 6 categories, and only one of these 6. So you have to figure out cash, okay, that's in assets, that's an asset. And then once you figured out what category it goes into, then just remember this or remember this. And that helps you figure out which account is debited and which account is credited. Also, you got to figure out for each account, does it go up or down? You have to, just by the context of the problem. So we're going to give some examples. I'll upload this to Blackboard. Let's go back to the PowerPoints. So yeah, let's the initial transaction where Mike's Bikes received $30,000 from Mike. They changed the example. Steve Gates invested $30,000 in exchange for common stock of WebWork, whatever. let's go back to the Mike's Bikes one. Let's stay with Mike's Bikes. I mean, it's the same number. It's going to be the same journal entry, but let's stay with the same example. So if we go to the Mike's Bikes, let's see. So Mike's Bikes example from the PowerPoints on December 1st. So the first transaction, I'll number these transactions. The first transaction was 12/1/2019. And the two accounts that we determined were involved, if we go back, I'll stay out of presentation mode for a second so that we can go back and forth between the slides and go all the way back to the first transaction here. This one. The two accounts involved we determined were cash and common stock. And we determined that cash went up and common stock went up as well. So what's the journal entry? Well, we got to go put cash and common stock in the right category. Cash is an asset, and cash, we said, goes up by 30,000, so we need to debit cash. How do we make an asset go up? We debit it. And remember, debits are always put on top in the journal entry and indented to the left. So cash was debited for 30,000, and common stock is owner's equity, and we know it went up by 30,000. How do we make an owner's equity account go up? We credit it. So we credit common stock. Credits are always listed under the debits and indented to the right. This is the debit, and this is the credit. Debit again is abbreviated DR, not DB. Credit is abbreviated CR in accounting. And we could write a little description, issued common stock for cash. So the main thing I'm worried about is you guys knowing this. Let's do the second transaction. Paid rent in advance. We figured out the two accounts that were involved were cash and prepaid rent. We said that cash went down by 6,000 and prepaid rent went up by 6,000. And they're both assets. This also happened on December 1st. So it's cash went down by 6,000. Prepaid rent went up by 6,000, and they're both assets. So how do we make an asset go up? We debit it. And prepaid rent was the asset that went up. So we're going to put prepaid rent as the debit. And cash as the credit. Right? Cash is an asset. How do we make an asset go down? We credit it, according to this. Cash did go down, right? They paid the landlord $6,000 in exchange for the right to use the building for their bikes for the next year. That right to use the building for the next year for their bikes, to hold their bikes, is called prepaid rent. And the dollar value of that right is $6,000. To get that right, they had to give up $6,000 of cash. Let's go to the next one. Purchased merchandise inventory on account. The two accounts we determined were involved were merchandise inventory and accounts payable. Merchandise inventory goes up by $3,000. Accounts payable goes up by $3,000. Merchandise inventory is an asset. How do we make an asset go up? We debit it. So we're going to debit merchandise inventory for $3,000. Credit accounts payable. for $3,000. Accounts payable is a liability, and we know it went up. So accounts payable is an L. How do we make a liability go up? With a credit. So that's why we credit accounts payable for $3,000. You're definitely going to have to study this lecture carefully, make sure you understand the concepts. Whoops, didn't mean to go there. All right, let's go to the next one. Signed a bank note for cash. Two accounts involved were cash and notes payable. Cash went up by 20,000. Notes payable went up by 20,000. Cash is an asset. How do we make assets go up? We debit them. Notes payable is a liability. How do we make liabilities go up? We credit them. Number 5. We purchased equipment and we paid cash for the equipment, $15,000. Both are assets, cash and equipment. Equipment goes up by 15,000, cash goes down by 15,000. So we're going to debit equipment for 15,000 because it's an asset and it went up. We make an asset go up with a debit. We're going to credit cash 15,000. It is an asset and it went down. To make an asset go down, we credit it. So you see the importance of this right here. For the rest of the course. Whoops, I keep going to the online homework. And then finally, there were two more events that happened. We sold bikes, 2 more events that we had to make an accounting entry for. We hired that employee, but we didn't have to make an entry for that. So we sold bikes and we paid the employee cash. So we sold bikes for $12,000. And we talked about there's actually 2 journal entries that need to be made. One of the journal entries is to recognize revenue. So let's just make that journal entry. But there is another entry that needs to be made. I'll write both of them down actually this time, and then I'll explain the other one a little bit more later, because that'll come up in chapter 3 or 4. I think 3. So to recognize revenue, 2 accounts, cash, because it said we sold them for cash, and revenue. Cash goes up by 12,000 and revenue goes up by 12,000. Cash is an asset. How do we make an asset go up? We debit it. And revenue, which of these 6 categories is revenue? It's right here. It's a revenue and it goes up. We said it went up by 12,000. So how do we make a revenue go up? We credit it. What was the date? It just said during December. I'll just put it as of the end of the month. And then the final transaction that happened was we paid this employee $1,000. 2 accounts involved, cash and we'll call it wages expense. Cash goes down by 1,000. So we can go ahead and put cash as the credit. How do we make an asset go down? We have to credit it, which means that wages expense has to be debited. So often you can figure out the journal entry just by process of elimination. If you don't know what wages expense should be debited or credited, but you know cash should be credited, then wages expense has to be debited, right? Every journal entry involves at least 1 debit and at least 1 credit. But we can explain why wages expense is debited. Wages expense is an expense, right? It's in this category. And we know expenses went up by $1,000 when we paid our employees for their wages. Expenses go up by 1,000. And therefore, how do we make an expense go up? We debit it. So that's why wages expense is debited for 1,000. Yes, this increase of $1,000 in wages expense leads to a decrease of $1,000 in owner's equity because of the effect on the retained earnings. That's true. But to journalize it, this is the journal entry. Now we had a question. You're right, Alexis. There is another journal entry to so here's the other journal entry. So this is journal entry number 1 when we sell the bikes. This journal entry recognizes revenue. And the other journal entry, which I didn't get into because the PowerPoints didn't show it. If you notice here, they only show the one thing, the cash and the revenue. But there is another entry and 2 more accounts are involved. Merchandise inventory and cost of goods sold expense. I'll just go ahead and make the entry for completeness sake. So merchandise inventory would be credited. It's an asset, and we know assets went down in the form of merchandise inventory went down because we sold our bikes. So how do we make an asset go down? We credit it. And what was the dollar value? We received $12,000 from the customer for $3,000 worth of bikes. And I'm assuming we sold all the bikes that are in our merchandise inventory. So if we did sell all of them, then our merchandise inventory decreased by $3,000. And so there's the credit to merchandise inventory. And then expenses go up by $3,000 when we sell our inventory. Which expense goes up? It's called cost of goods sold expense. And how do we make an expense go up again? We debit it. I'm wanting to put this off to the right, make sure this is off to the right. And I'm running out of room. Let's explain cost of goods sold expense. All right, when we originally purchased the bikes, what was our journal entry? It was this, right? We debited an asset, merchandise inventory, for $3,000, and we credited a liability for $3,000. When we pay this liability off, we will debit the liability and credit cash, but we don't recognize any expenses, right? Not yet. So this $3,000 is treated as an asset first. We just spent $3,000, but it's treated as an asset. We have $3,000 worth of bikes in our inventory. That $3,000 worth of inventory becomes an expense when we sell the bikes. When we sell the bikes and our customer gives us revenue, gives us money for those bikes, now it's time to recognize the expense. And the expense is equal to what we originally paid for those bikes. So we just sold $3,000 worth of bikes. So time to recognize $3,000 worth of expense. This is an example of expenses recognized after paying cash. We originally bought the bikes, but we didn't incur the expense until we sell them. I'm getting ahead of myself. This is chapter 3. We're going to get into this next time. So that's all I'm going to say about this other entry. Keep in mind, there are 2 entries when you sell inventory. This is the revenue recognition entry, and this is the cost of goods sold expense recognition entry. This entry reflects your revenue and your corresponding cash receipt, and this entry reflects the fact that your inventory is gone and your corresponding cost of goods sold expense has been incurred. All right, notice throughout these transactions, let's just take, we can make a T account for each account that's involved in these transactions. Let's just make one. Let's make the cash T account. We can do this for every account involved. Let's just do cash. Cash first was debited for $30,000. So that's an entry over here on the left side. And then cash was credited for $6,000. When we paid the rent. And then cash was debited for $20,000 when we got the bank loan. And then cash was credited for $15,000 when we used part of the bank loan to pay for some equipment. And then cash was debited for $12,000 when we sold some of our bikes. And then finally, when we paid our employees at the end, cash was credited $1,000. And so at the end of December 2019, when we do 30,000 minus 6,000, right? Because a credit to cash is a minus. A debit to cash is a plus. 30,000 minus 6,000 is 24,000. Plus 20,000 is 44,000. Minus 15,000 is, what is that? 44 minus 15? I went blank. 29,000. Then add 12,000. So we're up to 41,000. And then we subtract 1,000. So at the end of the month, we have a $40,000 balance in cash. And the normal balance in cash is a debit balance. Normal means at the end of a period, what balance, what side of the T account is the balance on? Is it on the debit side or the credit side? And it's on the debit side for these accounts. These accounts have normal debit balances, and these other accounts have normal credit balances. It just means you wouldn't see at the end of the period cash having a net credit balance. It wouldn't make sense, right? You can't pay out what you don't have in terms of cash. All right, we have and this, you can do the same thing for any of these accounts that are involved. Equipment, now there only might only be one entry for one of these, like equipment's only involved once, but you do the same thing. This is just an example. We have a question? Devin said, in the future, are we going to have to write that sentence of what occurred at the bottom of the journal entry? The description of the entry? No, Devin, all you're going to be responsible for is just what I've done here. You don't have to write that sentence. You should know that they would write that sentence in their accounting records, just so with another employee, say one employee was doing the journal entry, but then later on another employee comes along and wants to analyze, they might not know what this was. I mean, you can kind of tell what it is right here just by looking at it, but for some of the entries, it's hard to tell. And so the little one sentence description underneath is, you do need to have that. But you don't have to make that in this class. Just know that it needs to be there, but I'm not putting the focus on that. Now we can talk about the unadjusted trial balance. So after all these entries have been made, we can get the ending balance in each of the accounts that were involved. Here's the ending balance in cash. Get the ending balance in each of the accounts, and then we can make the trial balance, which is just a listing of all the accounts with their ending balance. But we segregate the accounts into assets, liabilities, and owner's equity. So I think that's where we're going to go next in the PowerPoints. So let's finish off this, and then we'll be moving towards commencing. All right, what about this one? Recording the cash payment for wage expense. We did this. Which one of these is true? A, B, C, or D? Are you debiting cash or crediting cash when you pay your employees? Cash is an asset. No, not B. Let's go back. When you pay your employees, cash is an asset. When you pay your employees $1,000, what happens to cash? It goes down, right? How do we make an asset go down? So cash would be credited. So B can't be right because B was cash was debited. You only debit cash when cash goes up. When cash goes down, you credit it. Cash is an asset. Wages expense is an expense. It's over here as well. It's in this category as well. When you pay your employees, what happens to your expenses? They go up. How do you make wage expense go up? Debit it. Debit wages expense, credit cash. So A is the right answer. Definitely watch this lecture over before the exam, maybe twice. Make sure you understand these concepts. Let's talk about the trial balance. Like I said, it's just a listing of all the accounts from the general ledger. Oh, I didn't really talk about what the general ledger is. Just think about from this standpoint. Say you had like a book, and in that book for the year, you recorded all these journal entries. That book is your general ledger, or your journal, essentially. It keeps track of all your entries. Actually, it's not quite right. The book that keeps track of all your entries is called the journal. And the general ledger is, the general ledger essentially is all of these. Sorry. All the T accounts and their balance is the general ledger. Not just the balance, but the things that happen in the T account. So this is in the general ledger. Then there's one of these same thing. There's a T account for wages expense with all of its entries and so forth. And then the trial balance is just the balance in the account. So that's the difference. Now, today in companies, they don't by hand make these entries. It's done in a computer software system, like QuickBooks. If you guys have ever heard of QuickBooks, it's like that. But it's easier to teach these concepts from the standpoint of pencil and paper. Easier to visualize. But just imagine, instead of writing these things at the company, you would be entering a debit to cash for $12,000. There'd be some software program and there'd have a drop-down menu, and you would debit cash for $12,000 in credit revenue, just like you would do on the homework that you're going to do for this chapter. So you prepare the trial balance at the end of the accounting period, and it serves as a check that debits equal credits. It also serves as a check that assets equal liabilities plus owner's equity. And it helps you to prepare the financial statements. So here's the trial balance for Mike's Bikes, unadjusted, of course. Each account is listed with its final balance. We put the accounts with debit balances on top, pretty much. Notice there is an account down here that has a net debit balance on the bottom. But so what we do is we list the accounts, assets first, then liabilities, then owner's equity accounts, or any account that affects owner's equity, like revenue and expense. We put the name of the account and then the account's balance, and then make sure you put it in the right column. Is it a debit ending balance or a credit ending balance? Cash, merchandise inventory. Cash, we worked out the 40,000, right? Basically do this for each account and get the final balance. And if it's a debit, you put it over here on the left-hand side. And if it's a credit, you put its balance on the right-hand side, the credit side. Remember, debit means left-hand, credit means right-hand side in accounting. And then if you sum up the accounts that have ending debit balances, you get a sum balance 65,000 debit. And you sum up the accounts whose ending balance is a credit, you get a sum balance 65,000. So debits equal credits. That's what the unadjusted trial balance does. So which of these is true? The trial balance, is it prepared at the beginning of the accounting period? Is prepared after the financial statements? Serves as a check that debits equal credits? Lists only the accounts from the general ledger that have debit ending balances? C, you're right. A isn't true. Trial balance is prepared at the end of the accounting period. B isn't true. Trial balance is prepared before the financial statements. Still at the end of the accounting period, but before you make the financial statements. C is true. D isn't true. It lists not only the accounts with debit balances, but also accounts with credit balances. And then the final slide is about corporate social responsibility. Throughout this book, at the end of each chapter, there's a little blurb about corporate social responsibility. I'll talk a little bit about it for this chapter, so that for the other chapters, when we do the PowerPoints for those chapters, I won't talk about it anymore. I'll just skip over those slides. Corporate social responsibility has become increasingly important for companies. The idea here, financial reporting, and what firms are required to report by law are just the financials. And basically only things that can be measured in a dollar in monetary amount, like measured in monetary terms. And if it can't be measured in monetary terms, then it's really, you're not required to report it. This constraint though, if companies only did that, then they wouldn't report anything about corporate social responsibility, because a lot of times it's hard to measure if a company is being socially responsible. It's hard to measure the dollar amount of their social responsibility. So increasingly companies have voluntarily, in addition to releasing their financial statements to the general public, based on what the SEC requires them to do by law, in addition to that, they release a report that talks about how socially responsible they are. Like they'll talk about the carbon emissions, they'll talk about their employee safety, they'll talk about their workforce diversity and things of that nature. They'll talk about how green they are for the environment. And these sorts of things are becoming increasingly important, as reflected by, if you look at major companies and you look at their 10K that's filed with the SEC, it has their financial statements, but often many of these big companies have a whole report on corporate social responsibility. So they must think that's important to their shareholders, or else they wouldn't tell them about this. And it can be pretty important. And actually some of these things, like carbon emissions, you can actually measure the dollar value that you're adding to the environment. It's kind of a noisy measure. It's not a very accurate measure, but it's some measure of the dollar value that you're helping the environment by emitting less carbon and stuff like that. So for some of these things, it's easier to come up with a dollar value, and for other things, it's not. Keep in mind though, the company is not required to talk about corporate social responsibility, but many companies have started to do that voluntarily because other companies were doing it, so they did it as well. It's like peer pressure. It's almost becoming the norm. So that's all I have for today. Do we have any questions? Stop sharing here. Do we have any questions? Nothing, no questions right now? Can you repeat what the general ledger is? Yes, Lauren, the general ledger is essentially a list of all of these, all the T accounts and the transactions that happened in the T accounts that period. This is just an example of one of the accounts in the general ledger. General ledger is a listing of all of these. You're welcome, Lauren. Kyla says, can you please explain the difference again between adjusted and unadjusted? Yes. So if we go back to the PowerPoints, this is our trial balance, our unadjusted trial balance. So we had those 7 transactions that happened, and these accounts were affected by those 7 transactions. And these are the ending balances in these accounts. And so here's our unadjusted trial balance. At the end of the year, or at the end of the period, at the end of each month, for example, you prepare the unadjusted trial balance. And then after that, you have to make adjustments to that. And the adjustments you make based on documents that come in at the end of the period. Like for example, suppose, how to explain it? Like, you know what you paid for these bikes, right? That's why you were able to put that. But you don't know what the utility bill is going to be until the end of the month, until you get it. A lot of times you won't get the utility bill until like the next week of the next month. The utility bill for December will come in January, right, of 2019. Once you see the utility bill, then that would be an example of an adjustment you make. You have to pay the utility bill, so you would debit utility expense, you would credit cash. So you make some adjustments based on seeing, say you're, there's a lot of other examples, like depreciation is another one, and we'll talk about depreciation next in the next chapter. At the end of the month, you make your depreciation entries, you make your adjusting entries. They're called adjusting entries. After making those adjusting journal entries, some of these accounts, their value will change, and you'll add some new accounts that wasn't on the unadjusted trial balance. So you basically do this whole thing again, this trial balance again, after your adjustments. And still you're checking to make sure that the debits equal the credits. And then finally, after that, you can make the financial statements. Hopefully that makes sense. Tyler, do you make the trial balance after the recording process? Yeah, after you're done making all of your journal entries, you can make the unadjusted trial balance, and then you make your adjusting entries, and then after you've made all of your entries, including your adjustments, you can prepare the adjusted trial balance. Kenny says, will this lecture be on Zoom cloud meetings? Kenny, I upload the lectures to YouTube. The link is in the syllabus. You're welcome, Tyler. Guys, go and watch the YouTube video I'll put up for this lecture, and watch it carefully. Make sure you understand. It's the most important lecture of the whole course, because if you don't understand clearly, if you don't understand now what's happening, you don't understand especially this stuff that we did, then you will have trouble the rest of the course. And I won't really slow down too much later to explain those basic things. So make sure you watch the lecture video. If you have any questions, go to office hours, go to the TAs, come to my office hours. And I'll see you guys on Tuesday, and we will start working some problems from the end of chapter 2. Take care.